everyone. Hope you're all doing good. We were doing some past examination questions, so we'll work out some more examination questions. Next question is Duggan Co. This was asked in December 2018. So let's run through this particular question. Following extracts from the trial balance have been taken from the accounting records as on 30th June 20x8. So that is the year ending date. All right. Convertible loan notes, they've given a note number. So the value of the convertible loan notes is 5,000. Maybe we saw in one of the cases. This looks like the moment they give convertible loan notes, what do you think should come to your mind? Probably this is a compound financial instruments. Because of this conversion of loan into equity option is given, no? Because of that, the company would have given this instrument at lower interest rate. If that conversion was not there, the investors would have charged or would have expected higher rate. Probably. Let's read the additional information and figure that out. Next, they've given cost of sales, finance cost, investment income, operating expense, retained earnings. However, retained earnings is as on 1st July 20x7 and our year is ending on 30th June 20x8. That means they've given retained earnings ka opening balance. So probably we need to figure out the closing balance as such. Similarly, equity share capital they've given as on 1st July. So we need to see if the company has issued any additional shares during the year, due to which share capital may increase. Okay. So we need to find out again equity shares ka closing balance. They've only given opening. Tax they have given. Okay, tax I did not find it before. So there's a new thing. Tax is our having a credit balance. Okay, this stands for, this column is for the debit. All these numbers, all this 5,000 and all no liabilities is having a credit balance. So the tax is having a credit balance. We'll see what to do for that. Following notes are relevant. Duggan Co. entered into a contract where performance obligation is satisfied over a period of time. If performance obligation is satisfied over a period of time, we already did one question previously, examination question. Then how should we recognize revenue and cost? Based on progress percentage. Yes, that progress percentage you can measure using the cost incurred method, okay, or the like another one, work certified method. Sometimes in the problem they will only give up the progress percentage. Here let's find out. The total contract price is about $9 million. Okay. Total expected cost of the contract is $5 million. That means overall this is a contract is a profit making contract. 9 million is a contract price. 5 million is a total contract cost. That means this is not a loss scenario. This is a profit making contract only. So that means we don't have to worry. If it was a loss, then we have to book that loss right away. Doesn't matter whether contract has begun or at what stage the contract is. The moment you come to know that the contract is loss making, book that loss when you come to know it. Okay. So this is not such scenario. This is a profit making contract. Progress they've only given is measured at 50%. So we don't have to do it. Okay. Why? What? Hang on. Progress is measured at 50% as on 30th June 20x7 and 80% as on 30th June 20x8. Meaning we are on 30th June 20x8 now. As on 30th June 20x8, 80% is complete. Till last year, okay, we had 50% complete they've given. I don't know why they've given that. Let's see it. Okay. Alright, correct entries were made in the year ended 31st June 20x7, meaning last year they made proper entries. However, the contract should be accounted, they've accounted. But no entries have been made for the year ended 30th June 20x8. Current year, they did not pass any entry for it. Okay, that we need to figure it out. Alright, okay, this is one adjustment. We'll put up one working note for this and figure that out. Next is on 1st Jan 20x8. Duggan Co. was notified that an ex-employee had started out court proceedings against them for unfair dismissal. Legal advice say that there is an 80% chance that Duggan Co. would lose the case and would need to pay an estimated $1.012 million on 1st Jan 20x9. That means somebody has filed a case against us. So company has... Now we need to figure out whether we need to book a provision or we need to disclose this as contingent liability or ignore. Remember, we had already discussed in the chart. What is that? If you have to make a provision, there are 4 characteristics. Present obligation, arising out of past event, which will result in probable outflow of economic resources, and reliable estimate can be made of the outflow. If all of them are satisfied, then you make provision. One of the key criteria there is the probability. If there is more than 50% chance of the outflow, then you will book provision. If it is 50% or lesser, then we disclose contingent liability. If it is less than 5%, then we say it is a remote obligation, hence we ignore. Here the chance is 80%. So you will book provision or you will disclose contingent liability. What do you do? There is 80% chance that the company has to pay the money. So what will the company book here? Provision, P for provision, CL for contingent liability, or ignore? I for ignore. What do you think? P, CL, or I? What is according to you option? Type in numbers for me. What is that number? Yes. We need to make a provision here because the probability of outflow is more than 50%. Yes, no? Okay. That is one. Next. Alright. So, or one moment, another thing you need to keep in mind here is check when is outflow happening, sir. You need to pay, all right. You need to make provision. But for what amount? You're not paying the amount right now. When will you pay this amount? 1.012 million. On 1st January 20x9. But when is our year ending? Our year is ending on 30th June 20x8. That means July, August, September, October, November, December. 6 months later, we need to make this provision. That means what? The time value money ka concept. Yes, no? So this 1.012 million, is it the present value or is it the future value? That's 0.12 million. It's the present value or future value? It is to be settled on 1st January. That means it is a future value. So we need to use the discount factor and find out its present value, which they must have given. Check. Okay, or check. Based on this advice, Duggan recorded a provision of 200 or 800k. They have already recorded on 1st January 2008, but has made no further adjustments. The provision was recorded in operating expense. So they made a provision for 800,000. Okay, 0.8 million. Duggan has a cost of capital of 10% per annum. Okay, we need to check whether they made the provision at right amount. Okay, see here, we know we have already studied this in the chart also. If you want, I can show you in the charts also. So that you can have a quick recap of things. Yes, here. Provision to be created for the best estimated amount we had learned. Okay. There are two possible ways in which you can estimate the provision. One is most likely outcome or expected value method. If there are multiple outcomes, then we'll use expected value method. Yes. However, if there's only two outcomes, whether you'll pay or not pay, then we'll use most likely outcome. What do you think is the suggested one here? Expected value method or most likely outcome? Your employee has filed a case against staff. There is only two chances. No, either you will pay or you will not pay. As simple as that. That means you should use the most likely outcome. Correct? Most likely outcome method. Now just check what is the most likely amount that you will pay. Most likely amount you need to pay. The most likely amount to settling the provision is 1.012 million. Yes, no. So provision should have been considered at 1.021, but they have made a provision for 800. So probably it's a case of under provision. And moreover, provision should not be made at 1.021 million because that is a future value. Use discount factor and find out its present value. Suppose you get 900k. You found out the present value of that. Let's say you get 900k, assumption. I don't know the exact value, just I'm saying. Then provision is required for 900, but they've made it for 800. That means you need to make additional provision. Okay, they've made a short provision, make additional provision as such. Okay, and one more thing is the difference between the present value and the future value. It is what? The difference between the present value and future value is the time value money ka interest charges, meaning finance charges. That should be booked. The difference between present value and future value should be booked as the finance charges in SPL. That also we need to watch out. Okay. Alright, because that provision, again, we have to calculate that ACM table wala accounting. But watch out, this is for only 6 months because your year is ending on 30th June. The settlement is on 1st January. Okay. Alright, that is one. 1 minute. Some extra pop in. Let me close this out. Okay. I'm discussing again. I'll put up all this with the help of Excel, but just discussing once with you, so also you feel comfortable. The balance relating to tax and trial balance relate to under or over provision from the previous period. We know if there is under provision, we had a formula also. Remember, I showed you in the form of ledger, and I explained provision for tax with the help of formula also. If there is under provision, then we will add. If it is over provision, then we will deduct. Yes. I told you can also do it with the help of the ledger also. If you want to retrace your memory, I can show the chart also. There is the help of the chart here. Quickly, you can just check. Okay. 1 minute. Here, check the tax expense SPL. Are you able to see? Take the provision for taxation of closing balance so that you had under provision made in the last year. If it is over provision, deduct it. Or you can do it with the help of ledger. We have done in when I did IAS 12, I showed you both the methods. With the ledger also, with the formula also. Okay, same thing we need to apply here as such. Okay, we'll see that. We'll calculate again. By the way, if you want to buy these charts, okay, those of you can go to on our website learn.arivupro.com, select ACCA. You will be able to see ACCA here. Okay, under that you will be able to see select books. You can select chart book and buy it. Okay, add it to your cart and make the payment, the books will be delivered to you as such. Okay, but make sure that the address that you're giving is right as such if you want to buy the chart books. Or our online recorded classes also, you can go to learn.arivupro.com. I'm showing the website here. You can do it so. All right. Okay. Coming back to the question. Where was the question? Yeah, here. In addition, there has been decrease in taxable temporary difference. Taxable temporary difference means what, sir? I told you, taxable temporary difference means deferred tax liability. Yes. Deductible temporary difference means deferred tax asset. DTA, I told, is not tested much in your examination. Only thing that is tested is DTL. Okay. So taxable temporary difference, meaning you have to pay more tax. No, name itself is saying taxable temporary difference. You need to pay more tax. That is only is your DTL, deferred tax liability. So they're saying there is a decrease in deferred taxable temporary difference, which is nothing but DTL. DTL ka there is a reduction of 2 million in the year. So in the current year, they're saying there is a reduction of 2 million in deferred tax liability, not in DTL, taxable timing difference. On taxable timing difference only we create DTA or DTL. This is a difference amount. Normally we create DTA, DTL on the taxable difference, meaning take the difference multiplied by the tax rate. Do you know the tax rate? Yes, this company pays a tax rate of 25%. So DTL is not 2 million. 2 million is a difference. Of that difference, multiply tax rate. 2 million ka 25% is $500,000. Yes. So there is a decrease of deferred tax liability of $500,000. We already learned in our charts also. How do you get current tax, guys? How much is the provision you need to make in current tax? How much is the provision for tax? That is nothing but current tax plus deferred tax. Yes. Current tax plus deferred tax gives you your total tax liability. We're done in the problem. Here, deferred tax liability is reducing, they are saying. That means what will happen? Take the provision minus this 500 because deferred tax liability is reducing in this particular problem. Understood? Repeat that or got it? Repeat it or got it? This one. I'll do it, but just saying. Able to understand? Yes, got it. Okay, just to be sure, others also, for the benefit of the others, I'll just repeat this. So your total tax provision you need to make, the tax expense you need to book in your current year is nothing but current tax plus deferred tax. Here, deferred tax is not increasing. DTL is reducing. Hence, this take 2 million multiply by 25%, you're going to get 500 million. That you have to reduce it to get the tax expense of the current year. Because tax expense in the current year, you will show it in your SPL. No, that is the reason. Okay, again, I'll put up a working note for this. Dugan co-issued of 5 million 6% convertible loans on 1st July 20X7, meaning last year beginning. Because year is 1st July to 30th June is the year ending here. Okay, year beginning and year end. 1st July 20X7 is opening balance. No, correct? The beginning of the current year, we have issued about $5 million of convertible loans. The interest is payable in arrears, meaning interest is payable at the end of each year. These bonds can be converted into one share of for every $2. If you have to pay $2, then you will get one share is what they're saying. So you need to pay about 5 million. For 5 million, how much it will be? The double, correct? No. For $2, for one share. For 5 million, it will be 5 million divided by 2. Actually, it's not double, right? It's half. Yes. So about 2.5 million shares you will issue as such. Okay, that is what they're trying to say. All right. On 30th June 20X9. Oh, this date is important. What is this 30th June 20X9, guys? This is the redemption date. Yes, because you issued the bonds on 1st July 20X7. Due date for redemption is, or due date for paying back is 30th June 20X9. That means what is the term for which these loans are given? 1st July 20X7 to 30th June 20X8 is 1 year. 1st July 20X8 to 30th June 20X9 is a second year. That means these loans have been issued for 2 years. Okay. Similar loan without conversion rights. If you had not given this conversion wala biscuit, this add-on feature, then interest would have been 8%. Because you told the debenture holders, hey dude, I'll convert your debentures into equity shares. Because of that, that feature, debenture holders told, okay, I will settle for 6%. So actual interest you're paying to debenture holders is only 6%. But if you had not given this conversion wala feature, then interest would have been 8%. So 8% is what? Effective interest rate. We've already done. In the previous examination question we worked out also, same thing was there. And these sort of questions, many questions were worked out. Dugan Co. recorded full amount in liabilities. Okay, they have shown full amount in liabilities. You tell me, sir, is this a fully financial liability or is this compound financial instrument? Is this loan a full-fledged financial liability or is it compound, CFS, compound financial instrument or CFI? It's a compound financial instrument. Why? It has features of equity as well as debt. Equity because you're converting into equity. It has features of financial liability because you have an obligation to pay interest. So it has features of both. So it's a compound financial instrument. So out of this 5 million, you need to find how much is a portion belonging to debt, how much is a portion belonging to equity. How to find out debt? We've already worked out. Find out the present value of cash flows, okay, using effective interest rate. That present value of cash flows becomes your debt portion. From the total proceeds, if you deduct the debt portion, you're going to get the equity portion as such. Equity is basically arrived as a balancing figure. That is not equity. We'll write it as other equity. I showed you the importance of that. Yes, fair enough. All right. In the last problem. And as recorded annual payment made on 30th June, 0.3 million in finance cost. Okay, because you have issued $5 million worth of loan, no? And this loan carries 6% interest rate. 5 million ka 6% if you calculate, that is $300,000, which is nothing but 0.3 million. That is the interest that the company has paid. That interest paid, they have booked it as finance cost. But we know for a financial liability, actual interest rate is irrelevant. We go substance over legal formula accounting. So we need to find out the interest as per which table? The ACM table, using effective interest rate. So we need to put up the table, find out the effective interest rate. Compare. Suppose effective interest rate is 0.4 million, let's assume. You put up the ACM table, you got effective interest. Finance charges as 0.4 million. That means what? They are booked only 0.3. That means 0.1 million more you need to book it in finance cost. Like that. Okay, we need to figure out. Just for the example, I told 0.4 million. We need to calculate that. Not very sure exact number is. So they have given discount factor. So which discount factor is relevant for us? Only effective interest rate, correct? No? So 8% is relevant for me, that I will underline. Okay. Next, Dugan began construction of an item of property on 1st July 20x7. Okay, the beginning of the year. Okay, which is completed on 31st March 20x8. So you have started constructing an asset on 1st July and the asset is completed on 31st March. That means how much time you took? July, August, September, October, November, December, Jan, Feb, March. You have taken about 9 months to complete this building. A cost of 32 million was capitalized to construct this building as such. This includes a 2.56 million being full 12 months interest on 25.6 million, 10% loan specifically taken out for construction. So what are they trying to say here? First of all, is this property, plant and equipment a qualifying asset? Is this a qualifying asset? Qualifying asset means those assets which take substantial period of time to get ready for its management intended use. Here it's taking almost 10 months. IAS does not give you what is the time period, okay? So it's a management call. They've already capitalized, so it is a qualifying asset indirectly they're trying to say. But if, first of all, if there is any qualifying asset, then any borrowing cost related to or directly attributable to qualifying asset can be capitalized, meaning that borrowing cost like interest and all, no, it will not transfer to SPL. It will be added to the cost of the asset is what IAS 23 says. Yes, no, correct, borrowing cost we have already done. But here, how much is the time period you took to for this, like you started construction on July, qualifying asset was completed in March. That means how much time it took? Only 9 months. That means how many months ka interest you should have capitalized? Only 9 months. But what did they do? Full 12 months ka interest they have capitalized. That means they have done excess capitalization. Okay. That means the 3 months ka interest cost, since qualifying asset is completed on 31st March and your year is ending on 30th June. So April, May, June, last 3 months ka interest, no, they should have not capitalized. They should have treated that as a finance cost and taken to SPL. But by mistake, they have capitalized. So one, like, you need to, finance cost will increase because of this. You need to find out how much is 3 months interest. One is that. And two, since they have capitalized, this company would have calculated excess depreciation. No? Since they have put this to, since they have capitalized, cost of the asset would have increased. Because of this increase, if cost increases, your depreciation also will increase. So two impacts will be there here. Okay. One, interest is should transfer to as finance charges to SPL, and they've done some excess depreciation which we need to reverse. Did you get the implication of this? For that only, they've given useful life is 20 years. Okay. We need to calculate. Numbers I'll calculate. What I'm saying, are you able to understand? If you want the chart reference also, I can give you in case you've forgotten. Okay. 1 minute. Let me show you the charts. There were 3 conditions for borrowing cost. If you remember, when will you commence borrowing cost? One, borrowing should have been incurred. Expenditure on qualifying asset should have been incurred. Activities on qualifying asset should have begun. This, with the day in which all the 3 conditions are satisfied, that is when you will start commencing or capitalizing the borrowing cost. When will you stop? When the activities on qualifying asset is complete as such. Yes. Or construction is suspended. Here, like, the construction itself got over within 9 months. So only 9 months interest should have been capitalized. But they capitalized entire 12 months. That is a pointer. Okay. All right. Duggan also recorded 0.4 million in operating expense, resulting depreciation. We got to know they've charged more depreciation. Since they've capitalized more, they would have got excess depreciation, which we need to reverse. We will calculate this as one working note. It has been discovered that the previous controller of Duggan engaged in fraudulent financial reporting. So some director has done some frauds. Currently 2.5 million of trade receivable have been deemed not to exist. They're showing extra trade receivables, sir. They're showing extra sales. Okay, they're not there only. They're showing it. And requires to be written off. They're saying write it off in the current year. 2.5 is bogus wala debtor they're showing. It is not required. You write off. That means they're showing it as debtor. How do you cancel a debtor? By crediting. Basically, they're asking you to calculate bad debts. What is the journal entry for bad debts? Bad debts account debit to your receivables or debtors account. Yes, but bad debts will be transferred off to SPL. Okay. So it will come off in your operating expense as such. So current year operating expense should come. Okay. But just check. Of this 0.9 million only relates to 30th June 2008. That means total bad debts is 2.5 million. Okay, or total bogus amount is 2.5 million. In that 2.5, 0.9 relates to year ended 30th June. 30th June is our current year, no? So among this 2.5, only 0.9 relates to the current year. That means balance 1.6 relates to earlier period. Earlier period ka it is this. That means this is what, sir? This is what? Accounting policy change, accounting estimate change, or is it a prior period item? We've already covered this. Can you tell me? IAS 8 cup. Is it what? What? Accounting estimate, accounting policy, or prior period? This is a prior period items. And if there is any accounting policy change or if there is any prior period item, then it requires retrospective adjustment, I told. So retrospectively, you have to adjust your retained earnings. One of the questions also we had done, I had shown you how retrospective retained earnings or restatement works. Okay. Fair enough. So the retained earnings for the last year is not proper. We need to restate that. So basically this 1.6 million will be shown, will be adjusted in retained earnings opening balance. I'll show you again if you've forgotten. 0.9 million is actual bad debts loss for the current year, which you will book it in operating expense. So operating expense will increase as such. That is the funda about this particular treatment. Can I go for the next one? The last adjustment here. On 1st November 2007, Duggan issued 1.5 million shares at full market price of 2.2. If you just check, 1 minute. Let me go to the, they've given ordinary share capital. Here in the question, check equity share capital, $1 shares they're saying. What does that $1 mean? Here $1, what does this $1 mean? The $1 is the face value of each share. But check, during the current year, the company issued some extra shares. How many extra shares? 1.5 million extra shares they've issued. At what price, guys? They've issued at $2.2 million. The face value of the share is $1. The issue price is $2.2. That means these shares are issued at what? These shares are issued at premium. So where will that premium go to? That premium will go to share premium or securities premium account. Okay, but here the proceeds were credited to suspense account. That means indirectly they have not even shown this. Okay, they have not, the capital shown in the question is incorrect. And if you just check in the question, security premium also they did not show. Meaning they did not account this properly. They just wrote bank account debit to suspense account. Actually the interest should have been what? Bank account debit to equity share capital to share premium. Instead of that they put it in share suspense account. So we need to correct. By the way, this particular transaction affects what? Does it affect SPL or does it affect SOCI? This particular adjustment. Statement of profit or loss, or does it affect statement of changes in equity? This particular transaction affects SOCI because there's a transaction happening between company and the shareholders. No, anything that affects your share capital or reserves and surplus, that comes under SOCI. So we'll take care of this in SOCI adjustment if at all they're asking. So first requirement is you need to prepare SPL for Duggan Co. for the year ended 30th June. So you need to prepare SPL because there were some obvious errors. And you need to prepare statement of changes in equity for Duggan. That carries about 5 marks. Last, you need to calculate also basic EPS, BEPS, basic earnings per share of Duggan for the year ended 30th June. So these are the 3 requirements of this particular particular problem. Looks pretty easy only according to me. Can we get started? If you have no problem. You have any questions for me before I get started? No. Alright. This is all geared up then. Okay, let's start. I'm using the same Excel file as I've done before. So if you just check all the previous year questions, I've done it here only. So I'll share this file again with you. So that one Excel file, you can have it for your reference. That would help you for your revision as such. 1 minute. I think Excel is a little bit smaller for you. No, let me just increase it, the size a little bit. I think this is good enough, right? It's visible, I think now. This is Duggan wala problem. So I'll write it as Duggan and Co. Okay, then first requirement. What is the first requirement they're asking? Statement of profit or loss for the Dugan for 30th June 20x8. So I'll copy this. This is the first requirement. Okay, copy. Maybe I'll have to do it individually. Yeah. Paste. No, paste option is only not highlighting. Okay, no problem. I'll just give it in small words then. Okay. SPL for year ended. SPL for year ended. What is the year ending? 30th June, right? So let me just write 30th June. June 20x8. Okay, SPL ka format, you know. If you want fatafat, you can write the format also. And I think all the numbers are in thousands here. Yeah, I'll keep the format ready so that it will be helpful for me. All the numbers are in dollar thousands. Can you remember the format? What is that? First thing is revenue. After revenue, revenue minus cost of sales. Yes. Revenue minus cost of sale will give you your gross profit. From GP, what do? From GP, you deduct your operating expenses. Yes. Operating expense will be your administrative expense, etc., etc. They've not given the split in the question. They've directly given the, like, you know, every copying is having issue. No. Okay. Alright. Operating expense, like distribution, administrative expenses, they've not given separately. They've just given operating expense. I'll take this. So GP minus operating expense will give you operating profit, operating income. From operating income, consider your finance charges, and then you consider your investment income. Once you consider this, you're going to get profit before tax. You have an option to copy this in your examination. Okay, from the question itself, you can copy and paste it onto your spreadsheet in exam. I'm having some copying issue. I don't know why, weird. Okay, but so that's the reason I'm just typing it out. From profit before tax, you deduct the tax expense. From that, you're going to get the profit for the year. See here, we read the question. We didn't find any OCI. In the last problem, I think we had seen OCI, but in this question, there is no OCI as such. Okay. So like, and I've just used the drag and drop option to enhance it. Or if you want, you can just do it like this and enhance the, make the formatting proper there. Okay. These are the numbers for me. Okay. Then they also asked the SOCI, no? So let me just copy that. SOCI also for the same thing. Or maybe can I copy SOCI this time? This time will it allow me to copy? Let's see. Let's maybe try it out. Statement of changes in equity. Copy. Paste. No. Still copying error. Crazy person. Okay. Alright. No issues. SOCI. SOCI for the year ended. Year ended 30th June 20x8. Okay, SOCI we know. What are the things that will come in SOCI, sir? It basically captures all your share capital and all the reserves. First column I'll maintain it as share capital. Then even though they have not given share premium, we know that some extra shares were issued at premium. So share premium will come in the question. So let me have a column for that. Share premium. I'm just extending the screen. You can just use this option to extend also. Share premium, and then will be your retained earnings. Okay. Alright. One thing I should not forget here. Can you tell me one thing what I should not forget? One thing I should not forget here. This came in the last paper we also solved also. One more thing is there. Can you tell me what is that one more thing, guys? But somebody is responding. So what is that option? Perfect. Other equity. Because you have some compound financial instrument, no? So compound financial instruments will also have an equity portion. That we put it under other equity. So do not forget that. Okay. That you will not be able to see it in your trial balance. That will come only as part of adjustments. Okay, here there is no revaluation surplus, so I will leave that. So that is not there. No other reserves are there. I think this is good enough. Okay, but also keep in mind one prior period item is there. So that will require some retrospective adjustment. So always remember that. Okay, or if you think you will forget those things, so what you can do is write opening balance, because some things we forget it. So what you can do is how the retrospective adjustment works is whatever retained earnings given in the question. Retrospective adjustment means you can't adjust in the current year. You have to go back and adjust. Okay. So there is one prior period bad debts. So the retained earnings opening balance, what is given in the question, is it correct or incorrect? The retained earnings opening balance given in the question, correct or incorrect? Last year that they booked some bogus bad debts. That means that has to be adjusted. That means the retained earnings given in the question is incorrect. Yes, no? So we need to write something here known as prior period items. Normally students forget this. This will have 1 or 2 marks. So kindly have this. So prior period items. So have this. Okay, that should come. This you will reduce from retained earnings. After that, you're going to get restated numbers. Okay, restated balance. Only your retained earnings will change. Rest everything will be the same. Okay. Have this format so that we will not forget it as such. Okay. In fact, you can write the amount also. Amount I think is 1.9 million. No? Some amount is 1,900 if you have to convert. 2.5 million was the bogus bad debts. In that 1.9 million was last year. So 0.6 million is current year. So 1.9 I've written here. 1.9 I'm expressing in 1000. So it will get it as like 1,900. So again I'll write it here. All the numbers are in $1,000. Okay. So this is what. Alright. This is about SOCI. I'll leave about 2-3 lines and then I'll have a closing balance. I think this was all the requirement. And one more thing, I think what other than SOCI, what else was required? You need to calculate basic EPS. So that is a third requirement. Okay. So basic EPS. Basic EPS is very easy, no? Like each divided by wage. So we'll have one column for each. Okay. Each you will get it from profit for the year. So I'll directly link it here. So each is nothing but this. Whatever profit I'm going to get it here, no? Alright, I'll link it or maybe let me find it. I'll link it. That will be your each because there is no preference dividend. There is no adjustment. So profit for the year only becomes your each. Divided by each is nothing but earnings attributable to equity shareholders. Those of us who have not followed our class, each is nothing but earnings attributable to equity shareholders. Divided by, or maybe, right? Is it okay? No? Yes. So I can use the short forms of things. Divided by weights. Weights as in weighted average number of equity shares. So you need to calculate weights. So each divided by weights will give you your basic EPS as such. Okay. So maybe I'll have it here only. I'll put up weights as a working note. I'll just put it up. I'll calculate that. Then you're going to get the basic EPS. Basic EPS, you're going to call it. You can just, we for our class purpose, we used to call it as BEPS. And diluted EPS, we used to call it as DEPS. Here they've asked basic EPS. So let's calculate that. So these are the requirements. Okay. Now we'll get to the working notes as such. Okay. So working notes, I'll put it up here. Workings. Or maybe one extra, I'll push it a little further just in case any extra things come in. Okay, workings. First is working note number 1. What is the first adjustment we saw? Coming back to the question, what is the first adjustment we saw? First adjustment we saw was the contract costing. So we'll write a contract. Okay. Contract accounting we will write. Okay. Alright. So now, first, contract revenue. First of all, overall position is profit only here. So I'll not mention that. And progress percentage they've only given. So I'll leave that out. Directly I'll start with contract revenue. So how much contract revenue you need to book, guys? The contract revenue that you need to book is how much? Maybe I'll have one working column here. I'll merge this. So contract revenue. So maybe this one I'll have it as a working column and then finally I'll write the amount here. Okay, check. How much is a contract price? Maybe I'll what here. Contract price is $9 million. How much percentage work is complete? 80%. Normally what we used to do, take contract revenue, multiply by progress percentage, you used to get the answer. But here you got to be a little more careful. What is that? Guys, see this 80% means what, sir? The work is totally 80% complete till the current year. Yes. Till the last year, how much work was complete? Till last year, 50% work is complete. That means till last year, 50% of the revenue they would have already recognized. Yes or no? Do you agree with me? Till last year, because last year they've done the accounting properly also, they told there. Current year, they did not pass any entries. Till last year, 50% work is complete means 50% of the revenue is already recognized. Current year, how much work is complete? 80%. So out of this 80%, 50% of revenue is already accounted. That means we should not book full revenue. We should book only incremental revenue as such. Did you understand this? So that is what you need to take. That means incremental revenue is how much over here? Perfect. So you need to book a revenue only to the extent of 30%. So that is what you need to show to the examiner. 9 million is 9,000 multiplied by 30%. Okay, if you want, you can write it here. Multiplied by 80 minus 50, I will write. Would that be okay with you? Minus 80% minus 50% I will show. So that will be a little easier. Did you understand this adjustment? Now this is my working column I'm showing. And the final number will be, or I can show that parallelly this side also. So the numbers will be, if I have to calculate. So contract revenue that you will book is, I'll just add the plus symbol there. System is acting a little weird in terms of copy paste here. Okay, no problem. Okay, so that means the contract revenue you will book is only 2,700. This is not accounted in the current year. So whatever revenue they've given in the question is incorrect. We need to add 2,700 to that. Okay, I've not updated the numbers yet. So we'll just see. So similarly, contract cost. Contract cost. How much will be the contract cost? Same funda. How much work is recognized? What is the total contract cost they've told? Expected cost is 5 million. So till last year 50% is already completed. Current year, by the current year end, 80% is completed. That means we only recognize the incremental cost. How much is incremental cost? 30%. Same thing. So here I'm going to write 9,000, not 9,000. I'll just copy this. But contract cost is only 5 million. No? So I'll make this as 5,000. Okay. This is my working. I'm showing it to the examiner there. Okay. Then I'll write the numbers here. Why is it taking so much time? Okay. So that means the incremental cost I need to recognize is 1,500. So cost minus revenue will give you your GPS such. Anyway, I'm adding respective P&L only I'm preparing. So profit I'm not finding it out. If you want, you can find it out. No issues. Okay. So these we need to recognize because they have not done there. Okay. That is what is you need to do in adjustment number 1. Got it? If you want, I can fill out revenue also. How much is the contract revenue they've told? Here check. They've only given revenue. How much is the revenue? Revenue is 43,200. So that means, is it 43,200? Is it 43,200? No. So if you want, I can just show a small working also here. It should be what? Revenue should be 43,200 plus I need to add one more what? 2,700. Okay. So that means the contract revenue will be 43,200 plus 2,700, which will be 49,900. This is the revenue you need to recognize. Similarly, cost of sale. How much is the cost of sale? They have given in the question. They have given 21,700. Okay. But they have not recognized 1,500. So I'll recognize that as well. So you can write in the question 21,700 plus 1,500. So cost of sale is this much. So that adjustment parallelly you pushed off. Okay. This is what is working note number 1. Okay. So I'll move on. I think no doubts here, right? Anybody having any confusion here? That's it with respect to adjustment number 1. If you have any doubts, I'll move on. I'm doing this because they told clearly in the question no entries have been made for this in the current year. If they had done it, this working note was not necessary. Since they did not do it. They did it only correctly in the last year. Current year they did not do. Hence we did it. Alright. Similarly, next is the employee ka provision. So I'll write working note number 2. Provision. Okay. Provision. Okay. So how much provision I need to recognize? So here we need to use what? We need to use which method here? Expected value method or which method we need to use? Or most likely outcome. There's only 2 possibilities here. Either you will pay the employee or you will not pay. That means what? Most likely outcome should be used. Okay. So we need to use most likely. You need to call that out if you have time. If you don't have time, if you think you're having shortage, all this you cut off, straight directly calculate. It is fine. Again, always take all these workings time versus marks. Okay. As I told you, you should not take more than 35-40 minutes. Now don't time. I'm explaining and doing. So obviously I'll take a lot more time. But when you're practicing, just check. Okay. If you feel you're crossing, then all these things, these wordings and all, you cut off. Okay. Directly start the calculations. It is fine. We need to use most likely method or most likely outcome method to estimate the provision here. To estimate the provision. That is the first thing I will write. So I'm just merge this cell. Okay. Most likely outcome here is what? Most likely outcome in this case is how much? In this case is how much they told amount was 1.012 million. Is $1.012 million. All right. Okay. So, but this is what? To be settled on which date? To be settled on which day we need to pay? 1st January 20x9. So on 1st Jan 20x9. But my year is ending on 30th June 20x8. That means I need to find out the present value. So what is the present value of provision? That is the future value what they have given. So present value we need to find out. How do we find out the present value? Present value is nothing but just take the provision amount. So if I have to express this 1.02, if you have to express in 1000, it will be 1012, can I say? Multiplied by the discount factor. How much is the discount factor? I think they gave the discount factor in the question. They themselves gave a 10% and they told 0.9091. So we'll use that 0.9091. Okay. So that means the present value of provision is 920. How much provision they made in the question? Existing provision created is how much? Existing provision made for only, they told they made in the question only $800,000 provision. So that means they made provision only for 800. So that means what do I need to know? They made the provision for 800. We need to make it for 920. So excess provision or additional provision made to be made is additional provision required. Required will be plus 800 or 920 minus 800. I'll round off that to 920. Okay. So 920 minus 800, that will be 120. So where will the provision go to? Additional provision. You need to book it under operating expense. Yes, no? So we'll just add that there. Okay. But also one more is there. What is that? Finance charges. Can you tell me? Finance charges, because you found out the provision ka present value you found out now. The present value of that provision is how much? Present value of that provision is 920. But how much you're going to settle the provision as? 1.02 million. The difference between that 1.012 million and $920,000. That is difference is nothing but time value money ka interest charges or finance charges. But that is for the whole year. Okay. Your year is ending on which date here? Year is ending on 30th June. So how much additional finance charges you will book it for? Check. How much is that? In fact, when you have to make the provision on 1st January and your year is ending on 30th June. So January, February, March, April, May, June. 6 months you need to make. Can I say that? Would my understanding be right? Finance charges will be, you need to take a 920 plus 920, multiply it by 10%, but only for 6 months. Did you understand this, guys? 46 we need to make finance charges in the current year, because you need to make the provision on 1st January. Okay, you will make the provision for 920, but your year is ending on which date? You made the provision on 1st January 20x8, because that's when obligation comes in. You need to make provision when obligation is there. Okay, so year is ending on 30th June. So January, February, March, April, May, June. 6 months. There is a difference. Yes, no? So with the time, the provision balance will go on increasing. If you want, I can write you the journal entry also for this. Initially make the provision for 920. So finance charges, what journal entry will pass? This only I'm writing for your reference. So the journal entry will pass is, we had already solved 2 problems based on this, I think. Finance charges account debit. Finance charges account debit to provision account. Same like your ACM accounting which you used to do it. To provision. How much is that? 46. All the numbers are in 1000. This you need to do. That means the provision ka closing balance will be the end of the year. You made the provision for 920. You added finance charges of 46. That means provision at the end of the year, 30th June will be 966. But by January from 966, it will become 0.1012. So that is where it will be settled as such. Okay, this just I wrote it for your reference. No need to write this in examination. Okay. All right. So this I need to book in. Let's push off all the data. Would that be okay with you? Is it okay? This is our second wala data. So because of the second data, what will happen? I think it could impact. There could be more operating expense also. That means, hang on, maybe because there are other things also, because depreciation also was accounted in operating expense. That was incorrect. So many things will come in operating expense. If you want, maybe current impact I can call out. Okay. So you got revenue minus cost of sales. So you have got GP. So how much is gross profit? GP is this much. Okay. Then operating expense. How much is operating expense? They have given in the question. They have given 13,520. We know it is not 13,520. Why? All right. One is this provision. Just check. They made the provision only for 800. We need to make additional provision for how much? 120. So we will add back 120. Then I'll put plus symbol. Fair enough. The finance charges. Finance charges, what, or maybe whatever they've given, first I'll copy. So operating income, how do you get? GP minus operating expense will give me. I'm not putting the formula, hence it's not showing the right value. It will get updated in a bit. Hang on. Finance charges is how much they've given. Finance cost they've given is 1240. Is it 1240 only? No, they've not accounted finance charges of 46. So I'll add 46 to that number. Alright, so far this is the impact in your SPL it will cost. So see and all, no change. It is impacting only your SPL as such. So working note number 2 and its impact are fully pushed. Can I go for the next, or you have any questions for me in this? No questions? All good? All good. Okay, that means I'll move on to the next, third adjustment. What is the third adjustment they told? Balance relating to tax in the trial balance relates to under or over provision. They are not telling whether it is under or over provision. You need to find out. Simple way to find out. Check. Provision. Sir, all this I told, no? All this is for credit. If you just check, all the cost of sale is an expense. It will have debit balance. Finance cost expense, debit. Operating expense, debit. So all the things which has debit balance, they put it in the first column. This one. All the things which has credit, they put it in this column. Okay. So provision for taxation, they've made it for 130. So you tell me now, provision is having a debit balance or credit balance? Provision is having a debit balance or credit balance? They're having a credit balance. Yes. So that means they already have a credit balance of provision. Okay, 130. You tell me now, how much is required? They have given provision here. Check. Where is that? I'll just show you that adjustment. The estimate, tax estimate for the current year ended is 2,100. Okay, maybe I'll write it down here for you if you want. Working note number 3, I will write it as tax. Maybe with numbers it is better to understand. So I'll write it as tax expense. 1. How much is estimated provision? Or can I say closing balance of provision? Would that be right? Because that's how we used to solve, right? Remember our normal working note IAS 37? Closing balance of provision for tax. How much is the closing balance of provision for tax? Closing balance, they've only given it as 2.1 million. So if I have to express in 1000, it will be 2,100. So you require a provision of 2,100. How much provision you already have, guys? How much provision you already have? 130. That means how much more will you make? 2,100 is required. How much you have? 130. That means how much more you require? Will you add 130 or will you deduct this 130? In 2,100 is required. 130 you already have. That means what should you do for this 130? Should you add or should you deduct? This should be deducted. Yes, no? That means what is this? Is this an over provision or under provision? This is an over provision. Alright. Did you understand? That's how to make out as such. Or if you want it as a formula. Okay. If provision for taxation has credit balance, it is over provision. If it has debit balance, under provision. Okay. Basically, I don't suggest a formula, but just say. Fair enough. But did you understand the logical way of it? 2,100 is required. You already have 130. Or if you want it in ledger format, we used to do it in ledger also. Remember? Provision ledger account. If you prepare provision account ka. So what will you write here? To balance brought down. How much balance? You already have how much balance, guys? Maybe I'll write it here. How much balance we have? Or I think provision is a liability. No? So liability will have opening balance on the credit side. So I'll write by balance brought down. By balance brought down. How much? They already have 130. Correct? But how much is the closing balance required of provision? They only told. This is provision ka ledger I'm preparing. This side is debit, that side is credit. So to balance carried down I will write here. Or to carry forward also you can write it if you're used to that way. To balance carried down, how much is required? Required is 2,100. Yes. Okay. Now is the provision ledger matching, guys? Is the provision ka ledger matching? Or there is a balancing figure? Check. This side total is 2,100. That side total is how much? That side also should be 2,100. You are getting as balancing figure. Bank they did not give. Check the balancing figure. What is the closing balance? What is the balancing figure? 2,100 minus 130. Yes, no. So this is what you need to make. What is this? This is the provision you need to make in the current year. That means you'll write by SPL. That is what I used to show in your chart also. Remember the chart? That's what I used to show it as the ledger. If you want to retrace your memory, once again, I'll just show you the chart format. So by balance brought down, to balance carried down, to bank. Tax paid they have not given. After adjusting tax paid only, their balance is left. So it is actually what they have given is not opening balance. After adjusting balance brought down and tax paid, no, they have adjusted and 130 still remains. That means they made an over provision as such. Okay, or rather they made an under provision as such. Is it okay? Are it's comfortable, guys? So hence you need to deduct it. So this is an over provision. Am I confusing you or are you getting it? Again, this is only for your reference. Again, this is only reference. Got it? Or any repeat once. I'll just give you 2 minutes for this. Or you can simply make it as a formula. Check in the question if you are having the credit balance of tax, then it is over provision. You can learn that also. If it is debit balance, under provision. Over provision means deduct, under provision means add back. So here we need to deduct. So I'll write it as minus 130. Okay. This is one adjustment I need to do. So if you are done, that you would have got SPL. Okay. But here one more adjustment is there. What is one more adjustment? Your deferred tax also is reducing. No? Correct? If deferred tax increases, your tax expense will increase because how do you get current tax? Again, this I'm writing for your reference. How do you get current tax or how do you get tax expense? Tax expense is equal to current tax plus deferred tax. Yes. This is how you get your tax expense. Fine. This is your current tax 1970. But here there is deferred tax also related to P&L items. Okay. Deferred tax means if deferred tax liability, you will add. If a deferred tax asset, you will reduce. Now here, just check. They're given taxable temporary difference. That means it is deferred tax liability. What is happening to that liability? Is it increasing or it is reducing? It is reducing. So if DTL is reducing, what we need to do? That means deferred tax is reducing. So that means what I need to do here? I need to reduce this. Okay, so I need to write here a decrease in deferred tax, or a DTL you can write. Decrease in deferred tax, in bracket you can write DTL. DTL is reducing, that is the reason. Okay, how much is the reduction? Not 2.1 million, don't write 2.1 million, okay? The decrease is not 2 point, the difference is 2 million as such, okay? Now you don't create DTL on the difference. You take the difference, multiply it by the tax rate. So 2000 into 25% is 500. So that much you need to deduct. So is equal to minus, I will write. So you need to minus this. That means what is your tax expense in the current year? The tax expense in the current year is, add all this. I'll just put up some formula. So if you add all this, you're going to get tax expense to be 1470. Okay. So I'll link it there here. Here already in SPL I have tax expense. No. So I'll link it off here. So tax expense is 1470. Any doubt anybody in this tax expense? Third working note is also done for. Okay. No issues they're saying. Others, if you have any issues, kindly speak up. Okay. So third adjustment is done for. Let me go to the fourth one. Fourth one is our compound financial instrument. So we'll write working note number 4. Okay. We'll write it as other equity. We are trying to find out the other equity, and we are trying to find out a lot other things here, but still we'll call it as other equity portion. First, what do we need to find out there? First is total proceeds. How much is the total proceeds you got? Or maybe we'll find out the present value of cash flows. Present value of cash flows. How do you find out the present value of cash flows? Put up the table. You need to have few tables here. Cash flow. Then what? You use discount factor. Discount factor at what interest rate? I think they must have only given discount factor at, they have only given for this adjustment. This one is effective interest rate is, or discount factor is 8%. So use 8%. Then the third column is what? Third column is payment. ACM table I'm putting, that's all. Okay. Or in fact here I'm writing present value, no? So not ACM. Cash flow, discount factor, and I'll find out the present value of cash flow. That's it. Present value of cash flow. This one such question, I think we have done many questions. Yesterday only we did one question like this. So I think it's a repetitive adjustment. Okay, how much is the cash flow, guys? You have given how much loan totally? 5 million. On this 5 million, how much interest is actually company is paying? 6%. So 5 million ka 6% is how much? 5 million is 5,000. 5,000 ka 6% if you calculate. So you're paying an interest of 300. And this loan term we already know. You gave the loan on 1st July 20x7 and it is getting redeemed on 30th June 20x9. That means the term of this loan is only 2 years. Okay. That means first year you will pay this. Second year you have to pay 300 plus the loan back. How much is the loan? 5,000. That means outflow will be 5,300. I'm trying to say if you had given, if you had given this much at 8%, then how much loan you could have raised? Okay, that will give you a financial liability portion. Or another way, I'm trying to find out the present value of cash flows. So 8% ka discount factor they only gave. I don't have to calculate. It is 0.926. Since I'm not able to copy, I'll just type in 0.926, and the other one is 0.857. So how do I get my present value of cash flows? This multiplied by cash flow multiplied by the discount factors. So this multiplied by discount factor. I'll copy the same formula down, Control C, Control V. So I'm going to get this. So I'll put in the sum formula here. So I'm going to get my total present value of cash flow is how much? 4819. So I'm going to round it off to 4820. Would that be okay with you? Okay. Present value is, or present value of cash flow is, I'll write it down here. Present value of cash flow is 4820. Done. So total financial liability portion. Or I'll write here financial liability portion, FL portion is, or I'll write it here, but that is not required at all. We'll cut it off. So we'll just write financial liability portion. Financial liability portion is 4820. So what is the total proceeds you receive from the loan? Total proceeds you receive from the loan is 5,000, so or 5 million. So I'll write that as 5,000. That means in 5,000, 4820 is financial liability portion. Balance will be your other equity. So your other equity will be, so 5,000 minus 4820. This is your other equity. Okay, generally we forget this, hence what do? This other equity will be shown in where? SPL or SOCI. This other equity will come in SOCI. So I'll go to the SOCI and I'll write off this. Okay, so convertible portion of debt I will write. I'm doing this in SOCI, statement of changes in equity, and I'm linking. Convertible portion of debt will come in other equity. So I'll link off this because generally we tend to forget this. That's the reason. So this is my linkage. So this is done for. Okay. Now, what do you do for financial liability? How do we account financial liability now? You took the loan. You took the loan on which date? You issued the loan on 1st July 20x7. Your year is ending on 30th June 20x8. That means this financial liability portion is on which date? Financial liability portion on 1st July 20x1, because the day you issued the proceeds, that's when you need to split. That means this value is on which date? 1st July 20x8. But my year is ending on 30th June or 20x7, no? 1st July 20x7 rather. 1st July 20x7 I issued this instrument. So financial liability portion is that. Going forward, how should I measure this financial liability? Using amortization cost. Yes, no. So I need to put up amortization cost table here. So what is your ACM table wala thing? If you remember, year. In fact, is ACM table really required here? You tell me honestly, is ACM table really required? Normally, when do you put up or what are the two intentions or reasons why we put ACM table? One, to know the finance cost. Another one, to know the closing balance of financial liability, because that will come in balance sheet. Yes, correct. That is the two intention we put up. Okay. So here, have they asked balance sheet? No, they asked only SPL, SOCI. That means ACM table, why are you wasting time? If you want to know finance charge, you want to know finance charges, no, just put it in one line. So opening balance of the loan will be how much? Opening balance of the loan will be 4820. Effective interest rate is how much here? 8%. So if you do 4820 into 8%, you're going to get finance charges. No, that's what you do in ACM table only. Instead of wasting your time in punching the table, directly I got it. Directly I did. Are you able to figure it out? This is a shortcut method. This is a finance charges. Where will finance charges come under? Finance charges will come under you have a separate category finance charges, no? So how much is the finance charges here, by the way? 385.6. So I'll round it off to 386. Would that be okay with you? So you have finance charges. One more thing I will write here. 386. How much did we get? I think 386 only, no? Yeah, 386. So I've added to in the SPL, I've added to the finance charges. So this also I have got it. Okay, these two I required, so I'll highlight this. Other equity I required, so I'll highlight this. That's all I required from this other equity wala working note as such. Okay, rest everything is fine. Okay, since they've not asked balance sheet, other things I don't have to worry. Okay, over one moment, hang on. In fact, finance charges is 385. In finance charges required. Okay, required is 386. But check, have they already accounted something? I think I read something they already accounted. Duggan recorded full amount in liability. Check, this is important. And has recorded annual payment made on 30th June of 0.3 million as finance cost. So how much finance cost they've shown? Actually, they've shown finance cost as 300. 0.3 million is 300. No, they have shown finance cost of 300. But what is actual finance cost? Is 385. That means will you make finance cost more for this much amount? No. So they have actually booked finance charges accounted. We will write. Finance charges required is 386. I'll write it. Okay. So maybe I'll just round off this. Okay, 386. So accounted is 380. That means how much additional finance charges is required? Additional finance charges only we need to account this year. Additional finance charges is 386 minus 300. Or I'll call out here only. Plus 386 minus 300, which is 86. So I am linking an incorrect number. So you don't have to book 386. You need to book 86 as such, because 300 they have already accounted. Is it okay? So I'll make that correction there. I'll go back and instead of 386, I'll make it as 86. Hope you got the correction. Yes? Because they've already booked 300 in this. That's the reason. Okay. So that is my, that's why I required this working note, which I have done it. Let's move on to the next working note. Anything else is there? Okay. An item of property. We know that extra capitalization they've done. They've taken a loan, they've taken a borrowing, and they have constructed a qualifying asset. But the construction period was only from July to March. July to March is 9 months. That means only 9 months ka interest they had to capitalize. But what did they do? They capitalized entire 12 months ka interest. That means they booked excess interest. So that means I need to put up next working note number 5. Excess borrowing cost I will write. Would that be okay with you? Because they have capitalized 12 months, but required is only 9 months. Excess borrowing cost capitalized, I will put up the working note as. You can give the heading whatever you feel comfortable, that is fine. So how much will be the excess borrowing cost? X is for 3 months, can I say? For 3 months, because the only 9 months they had to capitalize. So what I can do here, how much is the capitalization they have done? 2.56 million. 2.56 million is 2560. 2.560 is for 12 months. I require it only for 3 months. So can I write it as into 3 by 12? So I'll write 2560 into 3 by 12. 640 is what they have excess capitalized. One line I have got it. Would you be okay with that? If you want, you can show the working also to the examiner here. Just remove the plus symbol. That's all. Just write like this. That will give you the working. Okay, how to show the examiner, and just put maybe highlight of this something. How do you got it? Okay. Yes, this is the excess. They have done it for 3 months. Excuse me. All right. Now, if they have capitalized excess, that means this they have capitalized. That means they have increased the cost of the asset. If there's increased the cost of the asset, then depreciation also would have been charged more, no? Correct? So this 640 actually should have gone to SPL, but then unfortunately they have capitalized. That means you have some excess depreciation also. Since they have capitalized more, you get some excess depreciation also. Let's calculate that. How much will be that? 640 they have capitalized more. Okay. The 640 they told life of the asset is how many years, sir? Here only they told this plant has a useful life of 20 years. When was this asset ready for use? It was completed in March and the year is ending on June. When the borrowing cost, I told you, when the borrowing cost stops or when the borrowing cost ceases, depreciation starts. Because when the borrowing cost stops, asset is ready for use. No, that's when the asset is ready for its intended use. That's when you start depreciation. That means in the current year you will depreciate for whole year. No, asset is ready only on 31st March. That means April, May, June. Year is ending on June. Only 3 months you would have done depreciation. Correct? Yes. So 640 is the excess depreciation they've calculated. 640 they would have depreciated over 20 years. But only for how many months? If you do 640 divided by 20, you're going to get whole year depreciation. Is whole year depreciation they've charged more? No, only for 3 months. So into 3 by 12 I'll write. So this is the working. Same thing I'll copy here and just put one is equal to or plus symbol. Automatically this Excel will throw up the number for me. It means 8 is the excess depreciation. Did you understand? These two I required. Okay, excess depreciation capitalized and you can write excess depreciation. And depreciation you can call this working out. Or leave it, it's fine. It's okay. Everything not necessary to write down. Yeah. Okay. So now can we push this impact? Excess borrowing cost, sir. They have capitalized. That means this where will the borrowing cost go? Borrowing cost is a finance charges, no? So under finance charges, you need to add 640. So come to finance charges and add 640 because they have capitalized it. It's actually should have gone to SPL under finance charges. One more, excess depreciation of 8,000. All these numbers are 8,000. Where will depreciation come under? Operating expense. Yes, no. They've calculated more depreciation. That means operating expense is less or more. They've calculated more depreciation. Depreciation comes generally under operating expense. That means operating expenses increased. Hence, what do we need to do? We need to write minus 8. Yes. So I have just deducted from this. This is the impact of this working note. Okay. I think, yeah, rest everything we have set. So borrowing costs got done. I think we have done it. We'll move on to the next. Any doubt in this or all good? All good. Okay. So next is that fraud wala bad debts. Unnecessarily they book bad debts. Total bogus bad debts is 2.5 million, meaning 2,500 if you have to express in 1,000. In that 1,600 relates to last year, which we already did in SOCI, if you remember. In SOCI, I already showed that 1,600 by restating my retained earnings. I did that. So how much relates to current year? In that 2.5 million, 1.6 relates to last year. How much relates to current year? Only 0.9. 0.9 million you have to book now, no, bad debts. Where will bad debts come under? Under operating costs. Because of bad debts or operating costs, we need to book the bad debts now. So operating cost will increase or it will reduce because of this. Operating cost will increase. 0.9 million, no? I'm expressing in 1,000, so it will be 900. So I've added 900 here. That is the impact. So 1.6 million I've already called out in SOCI here. Prior period item. 1.6 or I've written 1.9. Huh? Actually, this is 1,600, not 1,900. Okay? Fine enough. Got it? I'll just add it in 1,900 by mistake. I've just changed it. Okay? One portion will go to SOCI, one portion will go to SPL. Can I move on to the next adjustment? Okay, next adjustment is related to your EPS wala calculation. Let me do a thing first. Let me find out the P&L because I require profit for the year for P&L. No? So let me do that first and then find out. So here I will just, maybe if you want, I'll show this to the examiner like this. This is my workings. So then I will put one plus symbol. Automatically I will get the answer. So my operating expense is 14532. Operating income, automatically I had given the symbol. So I've got this. Finance charges, again I'll show the working here to the examiner. What and all adjustments I've done. So then I will just put a plus symbol. So my finance charges is 2012. Investment income, anything they have given in the question? Investment income. Investment income, they have given it to be 120. So there was no investment income wala drama, no? We didn't get any income. Everything was expense only. So if you do this, you're going to get your operating expense minus finance charges plus your investment income. You're going to get profit before tax. From profit before tax, reduce tax expense, you're going to get profit for the year. So that is what we're doing here. Alright. So 4806 is what my numbers are showing. Just check, have a quick check. Is that the same number? Or 4806. That is the final number. And if you just check, all the numbers are also tallying. This is the profit for the year. I've given you any which way the solution also. Done. So problem is almost over, but they also asked, I'll highlight this because this is the thing. If you want, you can just, again, you have a highlighter option in your examination. I'm going to just show you the portal also. Okay. In a bit after I do the session. So this is the profit for the year. Okay. I'll highlight this, whatever answers are required. Okay. One requirement is this. Second requirement is SOCI. SOCI can we go for? First is the opening balance of everything. So check, come back to the question. How much is the share capital they have given? 12,200 is the opening balance of share capital they have given. Share premium opening balance is not there. Retained earnings opening balance they have given is 35,400. Okay. Other equity didn't have any opening balance. One prior period item ka restatement we already did. Okay. Due to this, what will happen? Can you tell me this is 1,600? I should reduce or I should plus? Minus or plus for this 1,600? There's a bad debts which should have been accounted in the last year. That means whatever retained earnings they've shown no is more. So we have to reduce this expenditure. So restated, I will just give a plus symbol. Okay. Or maybe here I'll just, okay, no problem. Maybe I'll give it off here. Plus this I will do. So I'm going to get the restated number and copy the formula. Other things will not be restated. Only this one will be restated as such. So be careful when you're putting the formulas. Next formulas you should start from this 27th row onwards. Convertible portion of debt, I got it. Anything else will affect SOCI? Yes. Profit for the year you have made, no? Whatever profit you made in the current year will be transferred to SOCI only, because you did not pay. You will transfer to retained earnings, then pay dividend out of it. If you don't pay dividend, that much profit will be retained in the business. So first we will write profit for the year. That I will not type in. I will just give the linkage. Profit for the year is how much? 4806. I've given the linkage. Do we have any SOCI or OCI coming in? No OCI. Other equity I've already bought in. Share premium? Yes, we issued some shares. No. So current year we have issued, shares issued we have. So how many shares have we issued? They have given in the question. If we just check the last adjustment, I think they gave something. 1 minute. They've issued 1.5 million shares. That is 1,500 at a price of 2.2. Face value of the share is $1. That means how much will share capital increase by? Plus 1,500 into 1. Correct? No, 1,500 share capital will increase by 1,500 into 2.2 is the issue price. $1 is its face value. So the premium element will be 1.2. No. So totally you would have got 3,300 by issuing the shares. That is 1,500 into 2.2. That I have split it up. Okay. A portion of this will go to share capital. Other portion will go to securities premium. So if you do that, you're going to get the closing balance. Now I'm going to give the formula. So is equal to sum of everything. So only do it from here. Restated balance onwards, take the formula here. If you are doing the formula approach or if you're manually calculating, that is also okay. So these are my closing balance of SOCI. Check, have they got the same numbers? You can do one cross check. So these are the numbers they are getting. 1,700, 1,800, 38,066, 180. It is matching up. Okay. So I'll highlight this row because, or maybe only this much I will highlight, because this is my requirement, no? So I'll just put one color. If you want to do, if you have time to do all that coloring and all, do it. Otherwise it's fine, not really required as such. This is my second requirement. Third requirement is basic EPS. For that I know Ish is how much? Ish is here only I got profit for the year, which is 4806. Vains I need to find out. For Vains I'll put up another working note here, okay? So working note number, which is this? Working note number 6. Weighted average number of equity shares. That I'm calling it as Vains. Don't write this in examination. Okay, examination, write the full form. Maybe I'll write a full form only better. Weighted, only in class purpose I told you. You can use that short format. Weighted average number of ordinary shares or equity shares. How do you get that? Initially, how much was the share capital? Check. A simple calculation this is. Initially, how many shares we had? 12,200. Initially, we had 12,200. Okay. So, 1 minute. So, now check. So, this is on which date? You had the shares on 1st July. Okay. If on 1st July, you had 12,200 shares. When did you issue more share? The company issued additional shares on which date? 1st November. That means July, August, September, October. For the first 4 months, company had only 12,200 shares. Do you agree with me? For the first 4 months, July, August, September, October, they had 12,200 shares. Then afterwards, they issued more shares. So the number of shares will increase. Yes. So first 4 months. Then what do? Then number of shares will not be 12,200. It will be 12,200 plus 1,500. You issued 1.5 million shares more. No, that will become 13,700. Yes. If you want to show the calculation here. 12,200 shares you had, 1,500 more shares you issued. That means the number of shares will be 13,700. So that is what I'm just calculating here. So that means after 4 months, you had 13,700 shares. For how many months? For the rest 8 months. So into 8 by 12. So this is my working. Okay. So I'll just show this here parallelly and then put plus symbol. It will automatically calculate for me. Is equal to this plus this. So if you calculate that, or if you want just to be 100% sure, it's good practice to put in brackets also, okay, wherever you're calculating, so that it calculates the right number. It will not change in these cases and all, but just to be sure. So this is your weights. Okay, comfortable? So maybe I'll just push this a little forward and then I'll write veins here. Here, if you want, I'll write it here, veins. Then I'm going to write here veins is equal to 13,200. So I'll link it off. So veins here I have 13,200. All these numbers are in thousands only. So it is okay. So how do you get basic EPS? Basic EPS is nothing but each divided by veins. Each divided by veins will give you your basic EPS. So each is 4806. Veins is 13,200. This divided by that will give you $0.36 or 36 cents is your basic EPS as such. Check how much did they get. $0.36 or 36 cents. Here it's given. Okay. That is all. That's all. This problem is over as such. There's another examination question. To me, pretty simple. Okay. One thing, there is a possibility. If at all you have to be careful here is one is on the tax. Okay. Deferred tax liability is increasing. Watch out for that. If DTL reduces, then tax expense also will reduce. Another one thing is under and overcharge of provision. Okay. I've explained you multiple ways. Okay. Through logic, through the ledger and through formula. One of the things, whatever you're comfortable, you take it. Okay. That is another one. And there was one prior period mistake. If there is a prior period mistake, then retained earnings should be like adjusted retrospectively. I will again show you how the retrospective adjustment works here. Okay. Those are the three areas where you can probably make a mistake. Okay. And other equity you might miss out. And this shares issued also, there is a possibility that you may not bring this in SOCI. You might forget. These are something where you can, common mistake areas that I feel you can go wrong in. Okay, rest everything looks pretty straightforward to me. Any questions you have for me so far, guys? This question is over. You have any questions for me? No, all good. If there's no questions, okay. Then means you have got it, means let's do a thing. Let's take a break. So after coming back from break, we'll do one more questions relating to the examination. Thank you.